G'day, it's Ben Walker here, founder of Inspire Accountants, and I want to share today the differences between PAYGW or withholding, pay-as-you-go withholding, and then also PAYGI, which is instalments. Now, there is often confusion with this, especially as you start to go into the pay-as-you-go installment system. But the general differences is, or I guess at a high level, pay-as-you-go withholding is tax withheld from wages that you pay employees of your business. Now, that may include yourself as well as an employee, and it's something that you need to register for under the ABN and report on your quarterly BAS. Or if you withhold more than $25,000 in pay-as-you-go withholding tax a year, then you're required to report and lodge that monthly. Now, that's pay-as-you-go withholding, but what about pay-as-you-go installments? So pay-as-you-go installments is a way that the ATO, I guess, provisionally tax you on your expected income in the current or future financial years. And how it happens is that often when people start businesses, they earn untaxed income, untaxed business income. And let's say you run a business in a company and it makes $100,000 in taxable profit. It will have probably a $25,000 tax bill for that year. Now, what the ATO do is they see that all of a sudden you've got a company that pays tax and they assess you on the year that you've lodged, but then they say, well, under ordinary circumstances, if that year happened again, they adjust slightly for CPI, and they say, well, we expect you to have just a bit higher than $25,000 tax bill in the next financial year, all things being equal. Now, what happens is they put you into a pay-as-you-go installment system, which means that every quarter that company is required to pay pay-as-you-go installments, which is income tax in advance or provisional income tax. Now, the things to keep in mind, it may not just be companies. It could also be individuals or self-managed super funds that enter the pay-as-you-go installment system. Trusts themselves, because they don't pay tax, often we distribute them to family people in the family group or entities like companies. That's why individuals and companies pay those pay-as-you-go installments. So you may see, if you've got a notice about enrolling into the pay-as-you-go installment system, it's the income tax side, and it's based on what was lodged in the past. Now, a couple of things to keep in mind. If your current year that you're essentially the ATO is estimating tax for, if your current year is less than your previous year expected profit for the year, then you're able to vary those installments. So let's say in that company example where I said 25K tax and they're expecting, a bit more than 25K, let's say 26K for the current financial year that we're in, and that they'll issue you a quarterly bill for that. But if you think, based on your projections, that you might only have a $10,000 bill, then you are allowed to vary that installment that you get issued with down to 1 quarter, essentially, of what your expected bill would be, depending on the quarter that you're in. Because if you're sort of already 2 quarters in, you might get the equivalent of half a year's pay-as-you-go installments. With self-managed super funds, so most SMSFs or self-managed super funds do pay tax on contributions, on concessional contributions, but also depending on the status, whether it's a pension mode or accumulation mode funds will also pay tax. Therefore, most of them are required to pay those quarterly PAYG installments as well, and you'll get notices for that. And then individuals, where it's common with business owners, is where an individual receives a salary from a business that they run as a director, let's say, then there's no necessary requirement to enter the pay-as-you-go installment system, because there should already be pay-as-you-go withholding taken out of those wages. But where we do see business owners get into the pay-as-you-go installment system in their own names, or maybe the spouse, is where they run the business in a trust and they're distributing untaxed trust income or untaxed business income into their own names. So that's why an individual might have pay-as-you-go installments. The other thing is not just business, but also investment income, such as interest received or foreign income or capital. Capital gains is different because the ATO sees that as once off, and it's usually a CGT event that's happened. that there might be a large tax bill. So it shouldn't necessarily trigger pay-as-you-go installments on its own, but things like dividends as well. So with franked dividends or unfranked dividends, there still is a balancing amount of tax that needs to get paid. So it's not just business income that you might enter the PAYG installment system for, it could be investments as well. But if in doubt about anything here, then please reach out to your accountant and we can go into a bit more detail to clarify anything for you. Thanks.